Welcome to this episode of the Australian Finance Podcast. I'm Gemma Mitchell, and today we're talking about how to get started with investing your first $1,000. So this is for anybody who has been thinking about investing. Maybe you want to make sure in the new year that you have become an investor. You can actually get started with as little as $5, but today we're going to talk about how you actually get started. And if you've got your first $1,000, we're going to have some options there for you as well. If you're already an investor, I'm sure that you will still find something really great to take away from this episode. Now, these episodes go out on a Wednesday and we like to keep them short, sharp and shiny. So we like to keep them to 10, 15 minutes to keep you moving along on your day.
Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by BetaShares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, BetaShares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with BetaShares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast.
As always, please remember that this information that we're going to talk through today is for education purposes only. It's general in nature. It doesn't take into account your goals, your needs, your objectives. So it's really important that before you pick a share, a trading platform, the things that we're going to talk about today, you read their product disclosure statement, their investment records, go to the website, check them out and make sure that you feel like they're the right move for you. So really, really importantly, take this information, but make sure that you are getting the information that you need to make an informed decision. And if you're not sure still, there's lots of different resources and there's always financial advice. But we're going to go through the 5 tips to get you investing. Number 1 is to get clear on your time frame. So the money that you're investing should be for the longer term. So we don't want to be investing money that you're going to need in the short term, say in the next 2 to 3 years, maybe even 5 years. So investing's not for things like your emergency fund or your cash buffer. Your investing is for long term. And the reason that we want to invest for the long term and not have a specific date that you will need this money is because the share market goes up and down. So we don't want to risk you needing the money at a point in the market where it's actually down. And that means pulling out the money is going to give you a loss. So you really want to make sure that you've got a long time frame and you've got your other cash buffers, your cash flow working really well so that this money can just sit there for the long term and do its thing regardless as the market goes up and down. Number 2 is to pick your system. So when you're investing in shares, there's a couple of different options. The most common will be a brokerage account, and that's where you can buy and sell shares. The other option when you're getting started with $5 or $1,000 is a micro investing app. So a micro investing app is a platform that really does it for you. So one of our show sponsors, a friend of the show, we talk about them all the time, is Raise. So Raise is a micro investing app. We also talk a lot about Pearler. So Pearler is also a sponsor, a regular on the show. They have an online broking platform, but they also have the micro investing app side of things as well. So micro investing is when you pull your money together with other people. So you can get started with as little as $5. Whereas when you go to a brokerage platform, generally they'll have a minimum amount of the share that you want to buy that you have to buy into. So it might be $500 parcels or $1,000 parcels. So that's something really important to take into account when you're looking at what platform you're going to use. So brokerage platforms are great if you're going to be doing bigger amounts consistently, like regularly. So you might be doing, $500 or $1,000 each pay. That can be really valuable. If you want to get started on smaller amounts, $5, $10, $20 here and there, micro investing apps can be great because they just let you add any amount that you like above that limit as you go. And it can be, you just chip away at it and the fees are very different. Whereas a brokerage platform, you will generally pay a brokerage fee, and that might be anywhere from $5 to $20, depending on which you pick each time you invest one of those parcels. So knowing how much you want to be investing and how regularly is really, really important. When you're picking a platform, I find that a lot of people stumble here because there are so many options. So I've already mentioned Raise and Pearler, but there are so many out there and they really do a lot of similar things. The most important thing here is, I think, just get started, because as you learn more, you can always change down the track. It might be that as you're learning, you decide that there's a better way that makes more sense for you to be investing, you can always pivot your strategy. But just getting started means that you are on that learning curve, you're taking action and you're moving forwards. It can always change later, so don't overthink it, just get started. Number 3 is to pick your investment and pick something that's simple and diversified. So after you've picked your online platform, either your brokerage, your micro investing app, whichever way you're going to be investing, the next thing is to actually pick the investment that you're going to put your money into. So based on your time frame, your risk tolerance, how comfortable you are with the market moving, there'll be different options. But instead of researching different companies and trying to pick one share or a few different shares based on what you think the company or that particular market's going to do, I recommend just getting started with something that's really simple and diversified and has a bit of everything in it, because this is just to get you comfortable and in the investing market. As you learn more, you might decide to research companies and actually start investing differently. But to get started, something like an exchange traded fund, so an ETF, a micro investing app that has a portfolio that you can pick, based on your risk tolerance and your time frame. These are just really easy ways to get started. And it means that you have a bit of everything in there, not relying on just one single share or asset to perform. So it'll kind of like your super fund. If you look on the statement, you'll see that you have one investment there and it might be called the balanced or the growth. But under that, inside, what makes up that investment is hundreds of different companies and assets and things. So you can do the same thing when you get started investing with your own money. Think of it like a fruit salad or a box of Cadbury favorites. It's one box, one investment, but it's got lots of different things in there. So they will all generally perform differently at different times, and it can really help you smooth out your returns, but also takes away that analysis paralysis of which share do I actually invest in? So number 3 tip is to pick something that's really diversified and it has a bit of everything in there just to get you started. Number 4 is to focus on consistency. So you don't need to be perfect and know everything about investing to get started. But if you're going to, you want to be doing things consistently. So if you've worked out what your cash flow looks like and you've decided, hey, this is the amount that I could potentially invest every week, every fortnight, every payday, you want to pick that amount, and if you can, automate it. So you might actually decide on the app or the platform and things that you're going to use to share invest based on features. So you might want reoccurring investments that automatically do it for you, rather than you having to physically buy the shares each time you have that parcel ready. So consistency beats timing the market all the time. It helps with our discipline, and it also means that we're putting money into the market regularly, so that maybe it was up. So maybe the market was up, maybe it was down, but what it's referred to as dollar cost averaging. And what it means is that it might have been up, it might have been down, but over the year, if you stay consistent, it should just all even out. And timing the market, so waiting on the sidelines, hoping for, the market to drop so the shares are a bit cheaper, or trying to time when it's perfect, means that you're sitting on the sidelines waiting, missing out on returns when you could have been in the market. So consistency is key to getting started and staying invested, because if this is your first $1,000, it won't stop there. You're going to build this portfolio up. So you want to be regularly investing and just pick an amount that you're comfortable with. Again, that can sit there for a long term. It's not going to be this money that you need for anything in the short period. And number 5 is to avoid rookie mistakes. So easier said than done, but you can learn from others. So rookie mistakes that I believe you can avoid. You don't have to make these mistakes to learn them yourself. So number 1 of the rookie mistakes is investing money that you need on hand, like your emergency fund. Remember, this is money that we don't want to touch. We want it to be able to grow and just let it do its thing. 2 is chasing hot tips. We've all been at a barbecue and heard an uncle or somebody have a hot tip on the next share. That's great. It's great to get excited about this stuff and be learning. But when you're just getting started, following stuff like this where you're not confident to do your own research can be really, really risky. So we see it all the time on social media. Somebody's got a hot tip. We hear it when we catch up with family and friends. So just try to keep on track with what you're doing, what makes sense for you, and start slow. Just trust your instincts of what you're doing. Avoid trying to guess or time the market. So trying to decide when it's the right time to buy or sell shares can be really, really challenging. So back to that consistency. So just avoid that while you're getting started. Well, actually, even if you're a really experienced investor, you want to avoid that. Just stay in the market long-term, regularly investing. That is going to make it for a much smoother, stress-free investing. Next rookie mistake that we want you to avoid is checking your balance every day. So chances are once you set up this brokerage account or this micro investing app, whichever way you decide to do it, you're going to have an app on your phone and you will get daily updates because the market gets updated every single day. You want to avoid checking it all the time, every day, because at the start, it can be a little bit exciting, but it can actually lead to you getting a little bit worried about it because the market's going to move. So we want to stop, getting obsessive over our portfolios. We want to be consistent, regular with investing and see this as a long-term asset that's going to move around. So try not to check it too regularly because it can cause a bit of anxiety, a bit of worry when things are moving around. And finally, the rookie mistake that we want you to avoid is panic selling. So you will hear things on social media, you'll read things in the newspaper, see things on TV. And a lot of the time when they're reporting on different things, it's all doom and gloom. This money that you're investing is for the long term, which means you can ride out dips in the market and things kind of going a little bit pear-shaped, remembering that this is a diversified asset, a diversified investment that has lots of different things in it. So chances are if one area is performing poorly, the others might be propping it up. But this is long-term money. We want to avoid getting caught up in the headlines and panic selling, which is where we can make a loss. So they are my tips for you getting started investing with your first $1,000. But as I said, if you're using a micro investing app, it might even be that you can get started with $5. If you want to learn more about investing at Rask, we have lots of free courses, lots of podcasts, but if you head over to Rask Education, you'll be able to see the blogs and all the courses that we have. They're completely free. There's a beginner's share investing course. There's a beginner's ETF investing course. There'd be great resources if you want to learn more.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel, or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.